Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. And this is going to be your last one until next Monday, as I'm taking a well-earned Easter break with the kids. Okay, what was happening yesterday? So we saw S&P higher. That was helped along by a very strong energy sector, but tech stocks were lagging. So Nasdaq closed small down, whereas S&P was small higher. Europe didn't do a lot, and China obviously drifted slightly lower as well. Now, we're just kind of not really. We're kind of treading water as we approach Easter, which is quite normal. And we've got key macro data coming up. Obviously, non-farm payrolls on Friday, although markets are going to be shut. And then we've got CPI the following week. Looking at commodities, gold did recover. Obviously, it was on the back foot a little bit last week. Recovered. Kind of seeing if it can charge back through that 2000 level. I think it's going to struggle a little bit in the near term. Probably needs like a catalyst to really break through there. Silver drifting, copper also drifting, so the other metals not doing so well. Obviously, oil had its big shift higher on the back of the OPEC production cut, and nat gas just still can't get going. So whilst it's not free falling, nat gas really not making any headway yet, and remains to be seen. We do still think it's going to have a pop at some point, given that how beaten up it is and it's losing downside momentum. But for now, it looks like it's in need of some sort of good news as well, which it's not getting. Looking at vols, they were mixed. No real clear picture there. Ups and downs, fairly small moves. Again, a lot of the vol repricing has already happened last week, whereas you can see on the week, we've got these massive drops in vol, which are effectively pricing Easter in already. So that's why it doesn't need to do a ton more now. In terms of commodities, we did see a pop in the metals vols, so vol higher there, silver, gold, and copper vol and a half. Nat gas was also higher, whereas oil drifted slightly. Carry wise, we did say we think carry is going to head towards the green from being deeply in the red as markets stabilize. That does seem to be happening. So you can see all of these are getting much closer to the middle. But looking at commodities, lots of healthy green still, which is providing you theta to be harvested. Anywhere that's not oil or gold, basically, in commodity land, it looks like implied vols are a bit rich to realize. So there might still be some juice there to harvest. I mean, looking at nat gas, right, we've got 85 implied vol versus a 50 realized. That's quite a big juicy amount of theta potentially to harvest if you are brave enough to sell vol in nat gas. And then skew wise, we did see skew drifting lower. Not massive moves in US and Europe, but drifting down and popping a little bit in Asia. Absolute levels of skew in Asia are obviously much lower in, say, FXI and Nikkei, so that they were basically bouncing a little bit there. And then in skew in commodities, we saw oil and nat gas skew lower, uranium skew a bit higher, and not too much going on in the metals. Moving on. So if we look at what's going on, sentiment's still weak, but seasonal strong. So we had BofA put out there, obviously, regular research. They've got various sentiment indicators that they look at to try and gauge, contrarian signals in stocks. They are suggesting that we're pretty close to extreme bearishness still. So you can see this kind of band of extreme bullish or extreme bearish. We're parked pretty close to the extreme bearish there, which generally isn't a good recipe for a short-term down move when we're looking like that. It's understandable that sentiment's bearish given the recent banking turmoil, given the fact that people are expecting a recession in the not too distant future. But as we enter into a seasonally strong period, and highlighted here on the Nasdaq seasonality, typically April is quite a strong month. And so where volatility has been falling into that Easter period, we've got a seasonally strong April. Markets are continuing to climb that wall of worry. Okay. Now we did call the move higher in stocks. Those who have been following our videos, those who subscribe to our research will know we had a long bias in our portfolios. That's worked out pretty well. We are now looking for ways to get slightly more defensive, try and take some of that delta exposure down. But we're not forcing it, right? We're just shaving little clips off as we go. We don't think there's that much more downside in implied vols now that Easter does look priced in. We're going to get major prints in terms of data coming through, like non-farms, like CPI, and the start of earnings season. So So we do think vol is running out of room on the downside. We've obviously been running some short VIX positions, slowly taking those off. We think the tailwind from vol control funds that have been adding length on these lower vols may be ending as well soon. If vol does bounce like we anticipate, it probably will. Whilst we might get one final squeeze up over that as we go into the quiet period at Good Friday, the Easter weekend, maybe 4,200 gets breached. It's very possible. But if you remember the last time 4,200 was touched, and that was Michael Hartnett of Bank of America's target to get short again, it was very short-lived, right? The market did not manage to stay up there for very long, right? We also know that the street is pretty long Vega on the upside after that big JP Morgan trade that went up end of last week. So we think there's going to be quite a healthy amount of resistance between 4,200 and 4,300 for the market. So for those of you who are waiting to get short or to exit your longs, we do think a breach of 4,200 will be a very, very opportune moment to do that. I'll certainly be lightening up on a lot of my deltas up there. We think banking concerns may also re-emerge as we enter earnings season. So we're cautious to chase longs here. Like I say, we're thinking of really taking longs off, adding some defensive trade, adding some defensive exposures, and maybe even some shorts in selected places. Okay. Now, another thing we've been looking at is silver. So that has kind of managed to rally back to the top of its range. So you can see, we had the cluster here where it was, here in December, January time. We had that sell-off down to the bottom of this kind of channel, this triangle. And now we've rallied back to the top of the range. So we have kind of breached this downward sloping top of triangle, right? If that's what we were forming, but we haven't quite breached the horizontal resistance line here, but we're pretty much right on it, right? If SLV gets above 22.5, then kind of away we go. Where could this thing break to? 25 seems like a sensible target. That was kind of these highs up here back in last March. So for us, 25, which is about 12% rally on SLV, if we get a break to the upside on silver, is a sensible target. Now, what will we do against that? Well, if you're already long exposure to silver, you've been happy about this sharp rally, but the fact that call skew is flipped into call territory, we think risk reversal hedges are a great opportunity for those who are happy to get rid of some of their longs up at 25 if we were to get there. So remember, what's a risk reversal? It's where you buy a put and sell a call. That's a bearish risk reversal. So our dashboard is screening as that is the optimal play. We're kind of here in the sell calls to buy bearish risk reversal territory. Why is that? Because spot is a bit stretched to the upside. It's because vol is kind of expensive to neutral. And also looking at the skew, whereas the skew, was neutral, it is now firmly in call premium territory. So doing short call long put is going to look particularly attractive when the skew is for call options. So looking at the specific trade that we would do in silver or in the ETF SLV, that's kind of our US listed preferred method. Okay, that's it for today. I hope you guys all have a great break yourselves. I think these markets have been pretty challenging over the first quarter. Everyone probably needs to take a breather and refresh. I'll catch you all next week. Cheers.